All right, so now we're going to start to get into our analysis here. We're going to look at gold for the next 1 to 3 month view. We've been, over the last couple of years, very bullish on gold. We've caught the corrections as the cyclical patterns have been great. And then we caught these big impulses on the upside. And now I'm going to show you this chart right here. And I'm bringing gold just about every week because there's so much interest in it. And there's a few things I want to do. Now, I'm not going to give a lot of description about the cyclical, about cycle analysis. You can learn that by going to askSlim.com to the cycle analysis workshop tab. And under workshops, and you'll see that. We called for this big upside move over here, and then we called for another big upside move over here in this green phase. That did not happen. It broke down. And when it breaks down, it gives us a message of a lot of trouble. This is in line with what we're looking at, inverse to the to a dollar market that we think is going to start to rebound starting in the next week or so. The dollar is exceptionally weak, as I said earlier in the show, with the euro currency exceptionally strong. Now I want you to see this is where the momentum turned negative right over here. It turned neutral right here for a little bit and then turned negative again. This breakdown under this key level turns this phase red, and now where we are is at an important level coming up here. So we thought we would get a rebound. We talked about it rebounding up to 1845 or a little bit higher. That actually is labeled wrong, that top one right there. That is approximately 1890 right there. So I'm just going to change that because I can't stand when it's wrong. So we're just going to say 1890. There you go. So 1845 to 1890 is really the area that we would believe that it would be able to rebound into and then move down again. This is what we consider to be a very risky zone, and because of this breakdown, these resistances are sell zones. So 1845, 1890, and then 1923. Over 1923 is the first warning of it really repairing itself, and over the 1967 level would be fully repaired, and it would turn it positive again. But you can see that is a long way. I mean, it has to rally up another $85 to even give us any kind of a warning past that 1923 level, and right now it's moving up into the sell zone with the highest probability that we're going to see failures in here. Right now, the correlations have broken down with the dollar and the gold market, or up until this week. This week, of course, the dollar fell 1.2%, and the gold market rallied up here about $45. So they're back in their inverse correlation after being in sync on the downside for the previous couple of weeks. So we think the dollar is about to bottom and get a rebound, and that's probably going to hurt gold. But that you could be range bound in here for a while. This area of about 1770 up to this area of about 1890. That makes sense to me over the next few weeks. But risks are to the downside. When you get breakdowns like this and in this red zone that we're showing you, then that area of 1845 to 1890 to us is a sell zone, and that would be the area we would want to maintain a negative bias. Or if gold was long in our portfolio, we would wonder about whether or not that was an area we wanted to affect our allocations and lower that risk. So we tried to get up to it in this last week, and we'll see how it acts if we get the rebound in the dollar we're expecting. Right now, the gold market is negative, and if you look at the blue cycle right in here, these are the minor cycles that you can see right there. So that's gold right there. This is GDX right here. This is silver right here. What that points to is this choppy area right in here, and then another serious area for potential decline into the beginning of February. There's another one, this blue one over here, which is also would be negative, moving down into May, and then potentially again into September, October. That does not paint a very good scenario. And as long as we stay underneath these resistance levels and repair levels that we talked about, repair, reevaluation, whatever word you want to use, as long as we're below those levels, then the risk rewards will remain to the downside, and we will be anticipating serious declines. You get a picture here of this big upward trend that we've had in here and the cyclical patterns. Now, when I get into Apple in a moment, I'm going to show you, I'm going to do some teaching around cycle analysis, will help you understand this. This is one of the busiest charts you will ever see, and one of our busiest charts also, because it has the colored phasing in there, that green, yellow, and red blocks that you see. We do that only in a few of our charts now for illustration purposes, for our members, really to learn the style. And we have a ton of members that are students of cycle analysis right now, which absolutely thrills me. So do go to askSlim.com, go under that tab that shows you workshops, and you'll see 2 workshops there, and take a peek at both of them if you want. So that is a look at gold, which in our opinion is pretty risky, with the potential for just a little more on the upside in here right now. And let's just peg what happens in the inverse correlation with the dollar coming up in the next couple of weeks.